Mastering Ind AS 12 requires navigating three variables: deferred tax assets, deferred tax liabilities, and specific tax routing through other comprehensive income. When these elements appear simultaneously in a complex problem, the calculation often feels disjointed. We will work through a case study for Zenova Mobility Limited, featuring varying depreciation, warranty provisions, and brought forward tax losses. We divide the solution into two phases. First, calculating current tax on taxable profit. Second, applying the balance sheet approach for deferred tax positions. Isolating these steps ensures that current year tax code applications do not interfere with the long-term carrying amount comparisons required for deferred tax. Step 1 is the current tax calculation. This table begins with the accounting profit before tax of 18 lakh rupees and adjusts for differences between accounting standards and tax regulations. Since accounting estimates are not deductible for tax purposes, we add back the 3 lakh for book depreciation and the 1,20,000 for the warranty provision. We also add back 40,000 in preliminary expenses. Because the tax code disallows this expense entirely, it is classified as a permanent difference. It increases our current taxable profit, but will not result in a deferred tax impact later. From this adjusted total, we subtract the specific deductions allowed by law: 4,20,000 for tax depreciation, 70,000 for actual warranty claims paid, and 1,50,000 of utilized brought forward tax losses. This leaves a final taxable profit of 16,20,000 rupees. At a 30% tax rate, the current tax payable for the period is 4,86,000 rupees. Having determined the immediate tax liability, we can now shift our focus to the future tax consequences residing on the balance sheet. The second phase uses the balance sheet approach. This matrix identifies the temporary differences between the carrying amount of assets and liabilities and their respective tax bases. Looking at depreciation, the accelerated tax deduction results in a tax base that is 1,20,000 rupees lower than the carrying amount. This is a taxable temporary difference, resulting in a deferred tax liability of 36,000 rupees. For the warranty liability, we have a closing carrying amount of 50,000 rupees, while the tax base is 0. When a liability's carrying amount exceeds its tax base, it creates a deductible temporary difference. At 30, because we used these to lower our current tax, we are now reversing a portion of the deferred tax asset we previously recognized, resulting in a 45,000 rupee charge to the profit and loss. Now consider the land revaluation of 2 lakh rupees. This creates a 60,000 rupee deferred tax liability. Based on the standard, where should this tax impact be recognized? The profit and loss account or other comprehensive income? It must be recognized in OCI. Under Ind AS 12, the tax treatment must follow the transaction. Since the revaluation gain was credited to OCI, the related tax liability must also be charged to OCI, rather than the current year's profit. To find the total tax expense, we combine the current tax of 4,86,000 with the net deferred tax impact routed through the P&L, comprising loss reversal, depreciation liability, and warranty asset. The resulting total tax expense is 5,52,000 rupees. We can verify this using the reconciliation formula, applying the tax rate to accounting profit adjusted for permanent differences. Using our data, 18 lakh accounting profit plus the 40,000 permanent difference multiplied by 30% equals 5,52,000. Both approaches match. The final accounting entry debits tax expense and OCI, while crediting the current tax payable and recording the net changes to our deferred tax assets and liabilities. By separating permanent differences from temporary ones and ensuring tax effects follow the underlying transaction, the application of Ind AS 12 remains logically consistent throughout the financial statements.